Welcome to the 401K Audit CPA Success Show, where we're 100% focused on helping companies across the United States prepare for their 401K audit. If you have 100 eligible participants in your 401K plan, then this podcast is for you.
Welcome, everybody, to today's podcast. We're going to talk through a very important issue that I think everybody will be interested in. We're going to talk about the type of errors that happen during 401k audits and what you can keep an eye out for. So this is actually a two-part podcast. So we're going to do part one today, which will be just in the compensation and contribution area. And then the next time we'll do another podcast on all the other errors that come up during an audit. So again, I'm joined by our audit director here, Kim. So Kim, welcome to the podcast and excited to talk about this.
Thank you. Yeah, great to be here, Jamie. Glad to talk about this very important topic, as you mentioned.
Yeah, I think everybody goes into an audit, and of course, they expect the best, but I think oftentimes the question is what can go wrong and what will go wrong. And so I think this is a really important topic, and hopefully we'll have a lot of people listening and understanding the audit process a little better through this topic.
Right. Yeah. And we'll talk a little bit also about things, even if you don't need an audit, things that you can be looking out for if you're administering your plan, just in general, because all of these apply in general, whether you need an audit or you only have a few people in your plan, they still all apply. So
great. All right. So why don't you get started? Again, we're talking about just compensation or contribution type of errors right now. So I'll let you get started, and I'll probably interject as we go through and ask some follow-up questions.
Sure. Let's start with compensation. As you are withholding deferrals from the people that want to participate in the plan that are your employees, the place that you often have to start is compensation, because usually employees will direct you to withhold a certain percentage of their compensation, something like 3% or 5%. So obviously 5% of a number is a calculation, but the beginning compensation number matters. And, we get a lot of people, they're like, well, why do we even need to talk about that? I mean, they get paid a certain amount, and how can that be a problem? But it actually can often be a problem because there are different components that make up what a person will get paid or what you could define as compensation. So you have to consider things like, is the person hourly? So they're going to get paid by the hour, or they're maybe salaried, which are going to get paid the same amount every pay period, or maybe they get paid once a month versus maybe other people get paid every 2 weeks or every week. So all of that factors into compensation. You also have to consider things like bonuses, commissions. Legally, that's compensation to the individual, and certainly from a tax standpoint, that would be considered compensation. But it depends for the plan. It isn't always considered compensation for the plan. Quite often, we see this as an area of confusion, and sometimes it's just an administrative error that the person setting up the payroll coding doesn't consider whether a bonus should be considered as compensation for the 401k plan. They'll usually think about it from a tax standpoint, but they don't really stop and think, wait a minute, how should this be handled for our 401k plan? So when you get to things like that, the first thing I would say is go check your plan document. What does the plan document say? Because most adoption agreements or full plan documents, whichever option you have, will specify the definition of compensation, and it will allow you to exclude certain things. So quite often we see for bonuses, plans will ignore this in their plan document, so there'll be nothing checked, which means that bonuses are included in compensation unless you specifically exclude them. Or you may have already thought about this and said, nope, we always want to exclude bonuses, and we do not want to have to defer on bonuses. We want the employees to be able to keep the whole amount of their bonus. Or you may have an option that you say, we're going to let the employees choose, so they can make a special election. So they may say, I want 5% of my pay withheld on my regular paycheck, but whenever I get a bonus, I'm going to come to you and say, no, don't withhold anything. Or maybe on a bonus, I want you to withhold 50%. So you may allow your employees to do a special election for bonus payments. Same thing could happen for commissions, but we see it most often with bonus payments. So I would say, first of all, if you're a plan sponsor and you're working in payroll, or you want to check on this, go talk to your payroll staff, find out what kinds of compensation do you have, what types of specific coding do you do in your payroll system. because that's another area that can crop up, is that maybe your intention was to follow your plan document, but it wasn't handled appropriately in terms of the payroll coding, because that's going to dictate what happens on an individual paycheck. So go talk to your payroll staff, find out things like holiday pay, bereavement pay. You may give a special holiday check of $25 or something. Find out what different kinds of pay do you have? How is it supposed to be handled per your adoption agreement? And then what is the coding set up in your payroll system? Because all of those things need to match. And then if you do have options, so you're allowing your participants or your employees to choose on a bonus, say separate bonus run, then work with your payroll staff so that they understand that. The other thing we like to see is that they're taking direction on optional decisions only via documentation. It shouldn't be that the payroll processor runs into somebody in the hall and they say, "Oh, by the way, I just saw I'm getting bonus, but I want to get that whole bonus. I'm going on vacation. I need all that money. Don't take out any 401k." And the payroll person goes back, writes on a sticky note, changes the payroll coding, and then throws a sticky note away. And then later on, somebody comes back, whether that's an auditor, a regulator, or it could be the employee themselves, and says, "Hey, I never told you not to withhold, or I told you, to leave the withholding. What happened here?" Those decisions should only be based off of documentation that you have, that you can keep either with the payroll run or in better cases, with the employee file. So there is documentation.
So, what I know you audit a lot of 401k plans. So, of those three that you mentioned, so you said that it's either withhold, don't withhold, or it's optional. Which is the most common that you see?
The most common that we see is people don't even think about this. And so when we go to look at the adoption agreement, you'll see a whole bunch of lines, and it'll say bonus, commission, and it'll have all these other different payment types, which people can check to either omit or make them optional, and they just ignore the whole thing. And so when we come in and we say, "Hey, we've had individual, Susie, and she had a bonus and she's participating at 5%. But we didn't see any withholding on the bonus." "Oh, well, Susie just told us not to, and so we thought that was okay." And no, that that is not technically correct. If you do not allow exceptions, then don't allow exceptions. If you want to allow that to occur, then you need to change your plan document. So the most important thing is that you understand what your plan document says and you follow the plan document. If you don't want it to work the way your plan document says, then you need to change the plan document or you need to change your process. Everything needs to be aligned so that you're following what your plan document says. That's the most important thing.
I also think what's really important is, and I think a lot of people who are listening to this podcast might not quite have 401k plans yet, and they're thinking about implementing one. So I think this is the type of stuff you should think about when you're implementing your 401k plan is, make sure that you think through how do you want to handle these type of compensation. So I think that's the other important part. So
Yeah.
one more follow-up question, and I'll probably ask this on each of these because I think one of the things that I remember back in my 401k day is anytime you hear the word error, you're like, "Oh no, what are we going to have to do? What's the penalty?" So I want to make sure that that's understood here. So let's say that I'm a 401k provider and I'm supposed to be withholding on bonuses, and I decided not to for 2 employees. What would my penalty be?
Yeah, it kind of is situational, but it's technically, if you have not withheld and you were supposed to, then you need to go back and do either a voluntary correction or just correct it on your own. But we would suggest voluntary correction. There are Department of Labor and both IRS voluntary correction programs that you can follow, and we'll be talking about those in another podcast. But follow the instructions. The first thing I would do if you figure out that this has happened or any problems like this, go to your third-party administrator or your service provider, whoever you work with that holds the funds and does the administration for your plan, and explain to them what happened. Go into the specifics and say, it was just an error. It was not intentional. These errors, and both regulators, Department of Labor and IRS, they understand these things happen. So that's why they've set up the voluntary correction program. So talk to them, find out what the specifics are for your situation, what you need to do, and then go down the voluntary correction route. But more than likely, you're going to have to fund as a company whatever you would have withheld, or at least a portion of what you would have withheld for that bonus payment or other missed compensation. Then you also have to consider that you may have a company match on that or some other type of employer contribution. You also have to fund that. So you've missed that probably as well. So you're going to have to go back and figure out what are those totals. You're going to have to fund that. The provider will have to put that into their respective participant accounts. And then there's a process you go through depending on what the error is and which voluntary correction program you go through. There's different procedures relative to that. So that's the best thing to do, is to talk to them. Tell them that you heard about voluntary correction programs. You'd like to go that route. We find that's usually the easiest and the least expensive way also. So that's what I would recommend. One other thing, which is probably going to lead us into our next topic, is that if you do find out that you missed something and that there should have been something withheld or an employer match or something like that and you missed it, the other thing that's going to happen is that those are probably going to be late contributions, which leads us to that topic. So why don't I just move into that?
Yeah, why don't you jump right into it? Yeah.
Sure. And this is, I will tell you, we see this on quite a number of audits in talking to other colleagues at other audit firms that are doing these types of audits. It is one of the most common errors that you see in these type of plan audits. I will also tell you the Department of Labor, it's a big hot button issue with them, and they are really cracking down as they're doing audits and investigations, as they're reviewing Form 5500 submissions, because this is something that will get reported on the 5500 form that you file annually. Also, that form becomes public knowledge also. So keep all of that in the back of your mind. If you think about your plan, you're running payroll on a periodic basis, whatever your payroll schedule is for your company, probably have withholdings on each of those payrolls. You submit those funds to your provider, and then they invest those funds as the participant has directed that they invest them, whether that's one fund or 20 funds, however they've split it. And you think, well, I've done that. I've withheld the amounts. I've turned them all over. I've funded whatever the employer contribution is. And we also have to think about loan repayments as a part of this, because that factors into it as well. But I've done all that. It's all accurate. I funded it. I don't know why they're talking about late contributions. Why would that even be an issue? Well, the reason it's an issue, the Department of Labor has issued guidelines that say that those funds need to be deposited as soon as administratively feasible, which is a bunch of wording that to most people doesn't mean anything. They're like, well, can't you just tell me 5 days, 10 days, 15 days? Give me a number and I can work with that. They won't do that because they understand that, again, it's situational. Every company has a different payroll schedule. They may run one payroll. They may run 20 payrolls, and they're all on different timing. And so it would take them a lot longer to separate out all the different components of payroll. Because if you think about running a payroll, you've got the original compensation amount. You got to go through all the calculations, figure all that out. Then you're going to have all of your withholding. So you've got federal tax, state tax, local tax, all the insurance type things, anything else the employee may ask you to withhold. You've got garnishments, and then you can have 401k withholdings and loan repayments. So there's a whole lot that goes into any payroll run. Department of Labor understands that, and they don't want to issue a guideline that's not going to work for somebody because they're working with all different size companies and all different complexities. So instead, they give us this guideline that says administratively feasible. But what that really means is that as you're running your payroll, you got to remember it's on a regular basis. How long does it take you, once you've actually calculated the compensation amount for each individual, you've calculated those withdrawal or withhold amounts, how long does all of that take? And then how long does it take for you to separate out the totals? Because you're going to separate out totals out of the payroll, send an amount to the federal government, going to send an amount to various state governments, et cetera. And then you're going to have amounts that you're going to send to your 401k provider. How long does that take? If on a regular basis, that's 1 day, that's your time frame. You should be doing every payroll submitting within 1 day. If that's 5 days on a regular basis, then that's your time frame. What's really important here is that you sit down with your payroll staff and figure out all of what I just talked about. How long does it take to do all those various components on a regular basis? not when you're under a crunch time, maybe somebody's on vacation or anything like that, just on a regular basis, given your workload, how long does that take? It's not as important, is it 1 day versus 5 days versus 10 days?
Mm-hmm.
It's more important to be consistent. So if you say, given our workload, given the staff that we have, given what we expect them to complete, given all their other tasks that they have to do, our timing is 5 days. That's fine. The DOL is not generally going to come in and say, nope, it shouldn't be 5 days, it should be 3 days. But what they will do is schedule out your timing. And if they were to do an investigation or just an audit of you as a company for your 401k plan, they would take 3 years worth of payrolls. They would schedule them out. They would see how long did it take from the pay date, so the date that the employee would have been paid, so that's the date they would have received the funds had it not been withheld, to the date it went into their account at the plan. So how long was that? And then they're going to schedule that out for 3 years, and they're going to look at the timeliness. And if they say, yep, generally it was 5 days, but here's one, they did it in 1 day, that shows me they could have done it in a day. So every other thing over 1 day is late. Now, what we see, either one option that we see a lot is people don't understand this. They think they can do it whenever they get around to it. So as I'm just running my payroll and it's 5 o'clock, it's time for me to go home. The next thing I was supposed to do was fund the 401k. I'll do it the next day. And so now that's taking a day longer, or it goes over a weekend. So there's a couple more days. They don't understand, or maybe they think I can fund whenever I want. So they'll fund 2 or 3 paydays together because I just got to the point that, okay, enough's built up maybe in my GL account of those withholdings I need to remit. So now I'm going to remit. That's a problem. That's not understanding the guidance. That's not following the rules. Then in those cases, at least 2 of those payments, if not all of them, would be deemed late. So number one, if you don't understand these rules, stop and understand your payroll, because you cannot do that. You need to fund them payday by payday. So we see that a lot. People don't understand that. They're funding them just as they get around to it, as they feel like doing it. They think that's okay. It's not. You don't do that. The other thing that we see is that they may understand the rules, and they have set up a time frame. And if you schedule out your, all the payments for a year, you'll see them pretty consistently, 5 days, maybe 4 days here, 5 days, 5 days. And then maybe the person that does payroll is going to be on vacation. So their backup comes in. You see it go one of 2 directions. It may take them longer because they don't do it on a regular basis. They want to make sure it's correct. So maybe they take 10 days to do it. Now that's outside the time frame. The opposite thing is what we tend to see, though, is that the person filling in, they want to make sure that they really, because they know timing's important, so they're really on the ball. And I want to make sure I do this ahead of anything else. So we see the timing for that one is 1. So now you're in a problem because you've shown you can do it in a day, even though on a regular basis it's the 5 days. So what the bottom line with all of this is, sit down with your payroll staff, figure out what are their tasks that they do as part of payroll, what's a reasonable date. And I tell our people, set it reasonably. Don't say, well, it's probably 5 days, but I could do it in 3, so I'm going to make it 3. No, make it 5 and be consistent. Do it in the 5 days on a regular basis. That's not to say if it's 5 all the time and you miss one and it's 6 days, that's going to be that big of a deal, but just try to make them as consistent as possible.
Yeah, it's interesting because I probably haven't done a 401k audit in 10 years, but I remember this being the number one issue when I used to do 401k audits back in the day. And I think that, like you said, the biggest thing was the amount of people we had to sit into a conference room and just explain this rule to. Like, how many people do not understand that it's like you said, it's establishing when is a reasonable time frame to do it, and then just doing that consistently, because you'd have to, like you said, it's pretty easy to audit. It's pretty easy to pull in the payroll dates. It's pretty easy to pull out the dates of the contributions happen, and then you can say, well, look, you consistently hit 5 days, but here's a couple of 12 days in here, and like, what are we going to do about it? So I think
what happened here.
Yeah, exactly.
Yeah,
so
exactly.
It's a very easy thing to audit, and it's a very easy thing to make mistakes on. Again, we've if I was timed on everything I did in my job, like, it'd be crazy that the amount of discrepancies there were of how often things happened and didn't happen. So I think it's that one area you just have to really, like you said, you have to have great controls around, you have to have great focus around, you really really have to understand this rule. So I think for people listening to this podcast, hopefully that's what they're getting out of it, is that this is a very not complex rule once you understand it. And I think Kim did a great job explaining it, but it's very important to follow it. So
Yeah, it absolutely is. And to go to our earlier conversation about what happens if you do have late contributions. So let's say you did the 5 days and then you had a couple that were the 12 days, those were deemed late. Again, there's a specific voluntary correction program that in most cases that folks will use. And the Department of Labor has a really nice online tool for this calculation that you have to do. You have to go back and figure out from the date that it should have been deposited to the date that it actually was, obviously is a number of days. And the online calculator then will calculate what they're calling lost earnings, because from the Department of Labor standpoint, those contributions should have been funded into the participant account. And then the market would move up or down, just depending on whatever happened with the market. And then those folks would have gotten the funding, or in today's case, probably would have had lost money out of their account. But they're assuming that it's probably going to go up, and you took away the opportunity. The bottom line is you took away the opportunity for that participant to manage that money in their account, because they can change contribution or their investment selections on a regular basis. So if a participant could see the market moving, they might change around their investment selection to best take advantage of what's happening in the market. And you didn't allow them to do that because those funds weren't in there. They weren't invested. So they will make you calculate lost earnings. You'll then the company has to fund that. And then they have to pay the administration costs for your third party administrator to work through all that. And stop and think, if you miss 2 paydays, that doesn't sound like a big deal, but you have to do it on a participant by participant basis. So what if you have 300 participants? You're going to have to pay your administrator to calculate every one of those lost earnings for each participant for each payday. So the lost earnings in today's world don't end up usually being a lot of money, but the administrative nightmare to fix this, it takes a lot of your payroll staff or your HR staff, whoever's managing the plan. It takes a lot of their time that they don't really have, and it will cost you money to get it fixed through the administration process. It's also a red flag to the DOL. So it's just something that it is fairly easy to avoid. If you do, as you just mentioned, have good controls, good processes, you check on it regularly, it's fairly easy not to have the problem. But once you get into the problem and now you got to fix it, it's just a tremendous amount of work.
It's just important to be educated on it. I think that's the key. And again, anybody listening to this podcast, I'm sure anyone who's listening to a 401 podcast is probably educated and really can understand this. So we appreciate that.
Right.
But I think it's really important that you're listening to this and getting that part of it. So I think you have a couple more items on there. But before we get to those, I did want to throw our email address out there. So we have an email, audit, AUDIT, at summitcpa.net, SUMMIT, CPA.net. We really want to make this podcast for the listeners. So if you have any questions, if you want to be a guest on the show and come in and ask questions to us, it'd really be awesome. So feel free to email us. And a lot of times we tailor these topics based on those emails we're getting. So please email us any questions we have. So I wanted to throw that email out there real quick, and then I'll throw it back over to you, Kim, for the last couple of errors you have on this list here.
Sure. And please do let us know any topics that you'd really like us to cover, because we want to make this as useful as possible. And all of the audits that we do, I'm sure we can probably answer your question. We've probably seen through our audits anything that you might have questions about. The last couple of things I wanted to just throw out there, these are kind of small things, but things that we do see. It makes the whole process so much easier if you make sure you align your payroll schedule with whatever your service provider, whatever you've told them to expect. So if you've told them every 2 weeks on a Friday, make sure you stick to that. That will help make sure that you don't have problems, maybe loan repayments that get missed, or it can lead to late contributions. So make sure you stick to that schedule. Make sure you communicate the schedule. If you're going to make any changes, let your service provider know. We also see sometimes people will run items outside of the payroll system. So somebody maybe needs a payday advance or something, or there's an error in the payroll, the running of the payroll in some of the things that you're putting in. We see this a lot with hourly folks, or again, those commission bonuses those payments, maybe you calculated it wrong, you need to make a correction, and you just say, hey, it'll be easier. Let's just cut them a check. I'm not going to do it through payroll. Just cut them a check and get them the money. That's okay if you want to do it that way, just to hurry up and get them the funds. But stop and think when you do that, your payroll system is set up to calculate all the taxes, calculate any garnishments, and also to calculate your 401k deductions and employer match. So by doing it outside of the payroll system, you've just given yourself a lot of extra work. So we recommend people don't do that or do it as infrequently as possible. We also recommend that people reconcile their contributions either as part of the 401k process, part of the payroll process, or part of your bank reconciliation process. But on a regular basis, just go in and make sure that you're probably doing journal entries into your accounting system, that whatever you're using for your company. So make sure that's matching up with the amounts that you're actually funding. Make sure nothing's showing up in your bank account reconciliation indicating that maybe there was an error. Maybe one of those payments got rejected or didn't get fully taken in by your service provider. If there's any kind of issues that show up in your bank account reconciliation that look like they're payroll related, pay particular attention to those, because that could indicate there's a problem going on somewhere along the line. It could impact your 401k plan. The last thing I wanted to mention is that your highly compensated folks will hit a maximum during the year. Every year, the IRS updates their maximums that they allow for contributions, catch-up contributions, et cetera. So make sure you look at those at the beginning of the year and you let your employees know, and also talk with those highly compensated folks. If they spread out their contributions throughout the year, that may allow them to maximize the employer match or employer contribution, or if they don't do that and they're contributing more upfront, then they may lose out on some employer match. So not that that's an error or a compliance issue, but just something to help out your employees, just something we like to point out.
No, that's definitely important. I think that's the key. And we've talked about this several times, but you're obviously running a 401k plan as a benefit to your employees. So you want to make sure you're doing everything right to properly benefit your employees. So I think that's a very important point, and definitely a type of an error you wouldn't want to happen. So
right. So I think that wraps up our conversation today on compensation and contribution issues.
No, I agree. I think this is very helpful. And I definitely learned quite a bit during this today. And it's nice to have it just outlined like this. Again, I know it's oftentimes this is people's biggest concern. They don't want to get audited because they're afraid about the errors they have. So just having them out there really kind of takes the sheet off the issues, and you really know what's going on. So I definitely appreciate all the time you took for this, Kim. And again, our next month, we will talk about part 2, and we'll go into some additional types of errors.
Great.
But definitely appreciate all our listeners. Thank you.
Thank you.
Enjoyed this episode? Visit our website at summitcpa.net to get more tips and strategies for achieving 401k audit success. We're here to be a resource with ever-changing rules and regulations.